You know, when you walk into a massive arena for like a sold out show, there is this overwhelming, almost primal sensory experience that just hits you before you even find your seat.
Oh, absolutely. It's visceral.
Right. The house lights start to dim and the bass is already like vibrating up through the concrete floor into your boots. You can smell that hyper-specific mix of stale popcorn and spilled draft beer.
Yeah, the distinct arena smell.
Exactly. And you have 70,000 people screaming in unison. In that specific instant, I mean, it just feels like pure, unadulterated magic.
It really does. It feels like this spontaneous eruption of culture. You know, you look around and you feel like you're part of this massive, organic, shared human moment that just happened to materialize in this room tonight.
Right. It feels like lightning in a bottle. But then you take a step back, you flip the script, and you look at how that exact same moment is viewed by the people running the building.
And the magic trick is completely revealed.
Exactly. It is not spontaneous at all. Behind the curtain, it is a ruthless, highly calibrated, completely data-driven machine designed to extract maximum financial value from every single person in that room.
It is a machine, a very efficient one.
And today, we have our hands on the financial blueprints of the most famous arena in the world. We are doing a deep dive into Madison Square Garden Entertainment Corp, so MSGE, and we're decoding their Q2 fiscal 2026 earnings call.
Which is just a fascinating document.
It really is. We are going to look at exactly how they engineer human emotion to the tune of almost $500 million in just 90 days.
I mean, it's a fascinating tension to explore, right? Because on one side of the ledger, you have art, emotion, cultural cachet. And on the other side, you have yield management, per capita spending metrics, operating leverage, and capital allocation.
And those sound like they shouldn't mix.
Right. But what this earnings call reveals is that those two sides aren't actually in opposition at all. The art is just the top of the funnel for the monetization engine. So whether you hold shares in this company or you're tracking the broader live entertainment market or, you know, you're trying to figure out why your last concert ticket costs so much. The mechanics of how this company operates are incredibly revealing.
So let's start with the sheer volume of cash moving through the doors, because the top line numbers here are just staggering. For the fiscal second quarter, which wrapped up on December 31st, MSGE reported $460 million in total revenue.
Yeah, $460 million.
That is a 13% jump year over year. But obviously, I mean, top line revenue is just the gross amount of money they collected. It doesn't tell us what it actually costs to, you know, turn the lights on and throw the party.
And that's why we have to look past the top line immediately. Because, look, anyone can generate $1 of revenue if they're willing to spend $2 to acquire.
Right. That's not a sustainable business.
Exactly. So the metric that management emphasizes, and the one that actually tells us if the underlying machine is working, is adjusted operating income, or AOI. And they reported an AOI of $190.4 million for the quarter.
Okay, so for anyone who doesn't spend their days staring at income statements, why is AOI the favored metric here rather than just looking at standard net income?
Well, because AOI gives you the cleanest look at the actual cash generated by the day-to-day operations. You know, selling tickets, hot dogs, sponsorships. It strips out the accounting noise.
What kind of noise? Like, what are we ignoring here?
So Madison Square Garden is a massive, capital-intensive physical asset. It has huge depreciation schedules. The company also has debt, which means they're paying fluctuating interest rates. And of course, they pay taxes.
Right.
So if you just look at net income, those external factors like a change in the corporate tax rate or some non-cash depreciation charge can make it look like the core business had a bad quarter when it actually didn't.
Ah, I see.
AOI filters all that out and asks a very simple question. Did the actual business of running live events make a profit?
And at $190.4 million, the answer is a definitive yes. But here's the data point that really jumped out at me. That AOI number is up 16% year over year.
16%.
So wait, revenue grew by 13%, but the profit generated from that revenue grew by 16%.
And that spread is probably the most important part of the earnings report. That 3% difference, that is operating leverage in action.
Break that down for us.
Sure. As a business scales, it has fixed costs. Heating the garden, paying the full-time security staff, maintaining the ice rink. Those costs remain relatively flat, regardless of whether you sell 1,000 more tickets or 1,000 more beers.
Right. The lights cost the same to run whether the building is half empty or totally sold out.
Exactly. Yeah. So once you cover those fixed costs, every incremental dollar of revenue you generate drops straight to the bottom line as pure profit. The fact that their profit is growing faster than their revenue means the machine is becoming more efficient.
They're doing more with the same space.
Right. They are extracting a wider profit margin out of the exact same physical footprint.
And you can really see the results of that efficiency flooding their balance sheet. I mean, their unrestricted cash went from $30 million at the end of September to $157 million by December 31st.
It's massive.
They more than quintupled their cash position in a single quarter.
It is a literal fire hose of liquidity. But, generating cash is only step one. Step two, which is what really dictates long-term shareholder value, is what management decides to do with it.
Right. How do they deploy it?
Exactly. This is where capital allocation comes in. And they tackled their balance sheet first. So they have $594 million in total debt. But during this quarter, they took some of that cash and completely paid down their $20 million revolver balance.
Let's unpack the mechanics of that real quick, because a revolving credit facility is basically a massive corporate credit card, right?
Yeah, the perfect way to look at it, yeah.
So why are they using it in the first place, and why prioritize paying it down to zero right now?
Well, a revolver is just a flexible line of credit that companies use to manage short-term working capital needs. Let's say you have a massive upfront expense in September, maybe booking fees, production build-outs, or marketing for the upcoming holiday season, but you won't actually collect the ticket revenue until November.
You need cash in the interim.
Right. You draw on the revolver to bridge that gap. But the catch is that revolver debt is typically floating rate debt.
Ah, and interest rates are high right now.
Exactly. In a macroeconomic environment where interest rates are elevated, carrying a balance on a revolver is expensive. So by wiping out that $20 million balance, they instantly eliminate that interest expense, which protects their future cash flows.
So it cleans up the house.
Exactly.
And then after that, they turn to shareholder returns. The transcript highlights that they repurchased 623,000 shares for $25 million in the fiscal year to date. And they still have like $45 million left in their authorization program to buy back even more.
Right. They're being very aggressive there.
But why choose buybacks over, say, issuing a dividend to investors?
It sends a very specific signal to the market. When a company issues a dividend, it is essentially saying, we don't have a better internal use for this cash to generate growth, so here you take it.
We're out of ideas, basically.
Yeah, exactly. But a share buyback is a mathematical manipulation of ownership. By going into the open market and retiring 623,000 shares, they reduce the total number of slices in the pie.
Making everyone else's slice bigger.
Right. If you are a retail investor holding MSGE stock, your specific slice of the company just became mathematically larger, and your claim on their future earnings just increased without you having to buy a single additional share.
Wow.
Furthermore, management usually executes buybacks aggressively when they believe their stock is fundamentally undervalued by the broader market. It's them putting their money where their mouth is.
Okay, I hear all of that. The margins are expanding, the debt is down, the buybacks are aggressive. But I have to play devil's advocate here and throw some cold water on this.
Go for it.
I'm looking at the calendar. We are talking about Q2, which for them ends on December 31st. We are talking about the holidays in New York City.
It's a busy time.
Right. So isn't this just the classic holiday retail phenomenon applied to the entertainment sector? I mean, every major retailer makes the bulk of their profit in the fourth calendar quarter.
Sure.
Doesn't this $460 million quarter just represent a seasonal cash harvest? Are we just getting excited about the Santa Claus effect rather than an actual structural improvement in the business?
I get why you'd look at it that way, and management openly acknowledges that Q2 is their seasonally dominant quarter. There's no hiding that.
Right.
But if you brush this off as just standard retail seasonality, you miss the actual operational mechanics of what they pulled off.
How so?
Standard retail seasonality means foot traffic goes up.
Yeah.
What MSG did defies standard retail logic because of the sheer density and pricing elasticity they achieved. We have to look at the underlying production data to understand why this wasn't just a busy holiday, but an engineered financial anomaly.
Okay, so you're talking about the Christmas Spectacular at Radio City.
Exactly. This production is the engine driving a massive portion of that quarter's success. Let's look at the raw output. This was the 92nd season of the show. They ran 215 paid performances, up from 200 the previous year.
215 shows in one run.
And over an 8.5-week stretch, they sold over 1.2 million tickets.
See, I want to pause and just visualize the logistics of that for a second.
It's hard to wrap your head around.
1.2 million human beings moving in and out of Radio City Music Hall in 2 months. That is the population of a major American metropolis funneling through those specific doors, getting their bags checked, getting their tickets scanned, finding their seats, buying a drink, watching the show, and then vacating the building so the cleaning crew can prep for the exact same process a few hours later.
Sometimes 3 or 4 times a day.
It is a staggering industrial operation disguised as a charming holiday tradition.
And the financial extraction of that operation is wild. That single production over those 8.5 weeks generated $195 million in total revenue.
195 million. So one shrink accounts for almost half of the entire corporate revenue for the quarter.
Yes, but here is the critical part. They didn't just grow revenue by adding 15 extra shows to the schedule. Management noted that per-show revenue increased by a mid-single-digit percentage compared to the previous year.
Meaning they made more money every single time the curtain went up.
Every single time.
But how do you pull that off? I mean, the venue didn't magically get bigger. There's still the exact same number of seats in the theater.
They pulled it off through 2 specific levers: ticket yields and per caps.
Okay, let's start with ticket yields.
First, higher average ticket yields. And this isn't just raising the price of a ticket by $5 across the board. This is sophisticated, dynamic yield management.
Like airlines do with flights.
Exactly like airlines. They are using historical data, demand forecasting, and real-time purchasing trends to price every individual seat in that theater at the absolute maximum amount a consumer is willing to pay on any given day.
So the prices are constantly shifting.
Constantly. A Tuesday matinee in early November is priced entirely differently than a Saturday evening show in mid-December. And they are constantly adjusting those dials to capture the maximum consumer surplus.
Wow. And the second lever.
Record high per caps.
Right, per capita spending.
Per cap is the industry metric for it, yeah.
Yeah.
It measures how much the average person spends on food, beverage, and merchandise once they have already crossed the threshold into the building.
So let me get this straight. Consumers paid a higher dynamically priced premium just to get in the door. And then once they were inside, they voluntarily spent more money on snacks and souvenirs than ever before.
That's exactly what happened.
Which gives us a fascinating look into consumer psychology. I mean, think about the mindset of a parent taking their family to the Christmas spectacular. You have already committed to the event, you've traveled into the city, you're in the holiday spirit, you're feeling generous.
They're not worrying about the budget that day.
Exactly. You are highly susceptible to the upsell. You are not going to look your kid in the eye and say no to the $20 hot chocolate in the commemorative light-up souvenir mug.
You just aren't.
You are fully monetizable in that specific emotional state. And MSG knows exactly how to build the physical environment to capitalize on that.
It is the perfect marriage of emotional resonance and economic extraction. Now, I should mention there was one macro headwind they faced, which makes those record numbers even more impressive.
Oh, what was that?
They noted a specific demographic weakness: a decline in international tourism. International buyers typically make up a very lucrative segment of their holiday audience, and that segment dipped this year.
Which points directly to the macroeconomic environment.
Right.
Because international tourism to a market like New York City is heavily dictated by foreign exchange rates, global inflation, and travel costs. If the US dollar is incredibly strong, a trip from London or Berlin becomes 20 or 30% more expensive overnight.
Overnight, yeah. It's a huge shift.
People pull back on transatlantic flights, which means fewer tourists wandering around Midtown Manhattan looking for last-minute tickets to Radio City.
And it's a great reminder that even a localized historic asset in New York is still tethered to the global economy.
Right.
But the fact that they suffered a drop in international tourists and still posted record ticket yields and revenue, I mean, that means that the domestic and local demand from the tri-state area was overwhelmingly strong. They absorbed the international loss without missing a beat.
All right, so that explains the $195 million Christmas juggernaut. But MSG is a portfolio company. What was happening across the rest of the footprint?
The broader venue portfolio, which includes the Garden, the theater at MSG, and their operations in Chicago, welcomed 2.9 million guests across 475 events.
475 events in 3 months.
Yeah. We were talking about Cirque du Soleil running 63 shows, professional tennis, UFC, WWE, and of course, massive concert tours.
I was reading through the venue traffic data in the transcript, and I noticed a spike in revenue related to the sports teams, the Knicks and the Rangers. But wait, the NBA and NHL regular seasons don't fundamentally change their lengths year over year. A season is a season.
That's right, 82 games.
So how did MSG make significantly more money off those specific teams this quarter compared to the exact same quarter last year?
It actually comes down to scheduling quirks.
Well, really?
Yeah. The NBA and NHL seasons are a fixed number of games, but when those home games are played, fluctuates based on arena availability, road trips, and league scheduling algorithms. In this specific fiscal quarter, the Knicks and Rangers happened to play a combined 4 more home games at the Garden than they did in the exact same 3-month window last year.
Ah. And every time one of those teams plays at home, MSG collects arena license fees, suite rentals, food, and beverage revenue.
Right. Those 4 extra games represent millions of dollars in high-margin revenue dropping into this specific quarter, inflating the year-over-year growth rate.
But that's a temporary boost.
Yes, and management was very transparent in pointing out that this timing impact will reverse later in the fiscal year. Because the total number of home games in a season is fixed, playing 4 more games now means they will play 4 fewer games in the spring.
So it evens out.
Exactly. If you are an investor building a financial model, you cannot look at that specific piece of revenue growth and extrapolate it forward. It is a timing anomaly, not a structural growth trend.
That is exactly the kind of detail that trips up a casual investor. You see the revenue spike and assume it's permanent, but it's really just a calendar shift.
I don't know.
Now, moving past the sports teams, we have to talk about my absolute favorite detail from this entire earnings call. The management team went into the weeds on the difference between food and beverage per caps and merchandise per cap.
Oh, this was brilliant.
And it is a masterclass in the behavioral economics of music genres.
It really is a brilliant observation. The CFO noted that at Madison Square Garden specifically, food and beverage spending per person was actually down this quarter. Yes. But overall spending per person remained strong because merchandise spending skyrocketed. And the driver behind this shift was simply the genre of music happening on stage.
Because last year, during the same quarter, the Garden hosted a lineup that was heavily weighted toward legacy rock acts. And this year, the calendar shifted to feature a much higher concentration of pop acts.
And those 2 distinct demographics exhibit completely inverted consumer behaviors once they're inside the building.
It makes total intuitive sense when you really think about it. Like, picture a classic rock concert. You have an older demographic, maybe a legacy band that has been touring for 40 years.
Yep.
The fans attending probably already have a drawer full of vintage concert t-shirts at home. They aren't going to spend $80 on a new hoodie just to prove they were there. So they bypass the merch table entirely.
Why? They don't need the shirt.
Where do they go? They go straight to the concourse bar. They buy rounds of premium draft beer. They buy food. The food and beverage per cap goes through the roof, while the merch per cap stays relatively flat.
But then, the next night, you swap out the rock band for a massive current pop star. The demographic shifts significantly younger. You have teenagers, young adults, and parents.
A totally different crowd.
Suddenly, the line for the bar is practically non-existent. The food and beverage revenue plummets. But the merchandise stands are under siege.
Yes.
These fans want the exclusive tour poster, the limited edition tote bag, the $80 hoodie. They view the merchandise as a vital piece of cultural currency. The merch per cap explodes.
Operating Madison Square Garden is essentially like running a massive luxury mall, but your anchor tenant changes every single night.
That's a great way to put it.
Right. On Monday, your anchor tenant is a high-volume pub that's the rock concert. On Tuesday, your anchor tenant is a high-end, hype-beast clothing boutique that's the pop concert. On Wednesday, it's a family restaurant for a Cirque du Soleil matinee.
That analogy holds up perfectly because MSG's business model is predicated on owning the underlying infrastructure of the mall.
They own the whole ecosystem.
They own the real estate, they own the point-of-sale systems, they take a percentage of the merchandise sales, and they own the food and beverage margins. They are completely agnostic to whether you buy a beer or a t-shirt as long as they understand the demographic of the room on any given night and optimize the supply chain to capture the margin.
And they did.
Yeah. Management explicitly stated that the surge in high-margin merchandise sales more than offset the drop in food and beverage. They adapted to the demographic shift and still extracted more total value per person.
Okay, so they clearly know how to squeeze every possible dollar out of the crowds they have today. But live entertainment is inherently volatile.
Very.
I mean, the holiday season ends, January hits, the tourists go home. How does MSG avoid a post-holiday financial hangover? How are they securing the audience of tomorrow?
This is where we shift the focus to management's future guidance, because they are actively trying to rewrite the business model of live entertainment.
Big words.
But true. The loudest, most impactful piece of future guidance in this transcript is their residency strategy, headlined by a staggering 30-night Harry Styles run at the Garden starting in August, which falls into their fiscal 2027 year.
30 nights. A single artist playing Madison Square Garden for a month. The scale is almost hard to process.
It's unprecedented.
The transcript noted that Ticketmaster saw 11.5 million registrations for the pre-sale. In a metropolitan area of roughly 8 to 10 million people, 11.5 million individual accounts registered to try and buy a ticket. The demand is absolutely astronomical.
It's wild.
But from a pure business mechanics standpoint, how does MSG structure a deal like this? During the Q&A, an analyst asked a very specific question. They asked, is this residency a co-promote or a rental? And the CFO clarified it is a rental. Why does that distinction matter so much to a retail investor?
Because it completely changes the risk profile of the revenue.
Okay, walk me through that.
So in a co-promote model, the venue and the tour promoter share the financial risk of the event. If the marketing fails and the show only sells half its tickets, the venue takes a financial hit alongside the promoter.
They eat the loss together.
Exactly. Conversely, if it's a blowout success, the venue shares in a larger percentage of the ticketing upside.
Makes sense. And/or rental.
A rental deal is much more conservative. The promoter, whether that's Live Nation, AEG, or the artist's own company, simply pays MSG a fixed, guaranteed fee to lease the building for the night. MSG acts purely as a landlord.
So they are essentially trading the potential for unlimited ticketing upside in exchange for a massive guaranteed floor.
Exactly. For a 30-night run, the sheer financial exposure of a co-promote would be massive. By structuring it as a rental, MSG locks in 30 nights of guaranteed high-margin rent, completely insulated from any ticketing risk.
No matter who shows up, they get paid.
Right. And furthermore, they still get to capture all the ancillary revenue we just talked about, the food, the beverage, the suite rentals, and their cut of the merchandise. They de-risk the base revenue while still maintaining access to the high margin per caps.
And the timing of this residency is not an accident either. They are running these 30 shows primarily on Wednesdays, Fridays, and Saturdays throughout August and September.
Which is key.
Right, because I look at that calendar, and those are historically the deadest months for an arena. The NHL hasn't started. The NBA hasn't started. It's the dog days of summer. They are taking the weakest part of their calendar and dropping a fully guaranteed, sold-out cultural phenomenon right on top of it.
They are solving a massive utilization gap. And it's not just Harry Styles either. They mentioned a 9-show Bon Jovi run, and they are actively negotiating theater residencies at their other properties.
This is a real pattern.
It is a profound shift in corporate strategy. Historically, live entertainment is a hit-driven, episodic business. You rely on routing, you hope a massive tour decides to stop in your city, and you hope it sells well. MSG is trying to transition that volatile model into something resembling recurring revenue.
Which investors love.
Love. If you can book 30, 40, or 50 nights of guaranteed rent a year in advance, your cash flow visibility improves dramatically, and Wall Street places a premium on visibility. Investors will assign a higher multiple to a stock with predictable cash flows than one that relies on the unpredictable whims of touring artists.
Okay, I understand the financial logic, but I have to push back on the cultural logic here. Madison Square Garden brands itself as the world's most famous arena. Its prestige comes from its variety. So if you lock up the building for 30 nights with one pop star, aren't you risking severe market saturation? Do you alienate the rock fans, the comedy fans, the country music fans who are used to seeing their favorite acts roll through the Garden in late summer? Is there a ceiling to how many nights you can give to one demographic before you damage the broader ecosystem of the venue?
It is a valid concern, and it's something management clearly anticipated. They addressed it by pointing to the staggered scheduling.
The Wednesday, Friday, Saturday thing?
Exactly. By running the residency primarily on those specific nights, they deliberately leave 4 nights of the week open for other tours. They also highlighted that their overall booking pace is well ahead of historical averages, noting that they have already secured first-time headliners across various other genres for the upcoming year.
So they aren't ignoring the rest of the market.
Not at all. Their thesis is that the New York market is simply deep enough and the demand for the venue is high enough that a 30-night pop residency won't crowd out the rest of the industry. They believe they can expand the pie rather than just reallocate the slices.
All right, so the revenue side of the future looks incredibly strong, but a deep dive isn't complete without looking at the expenses.
We have to look at the costs.
The CFO used a very specific, classic corporate euphemism during the call. He said their SG&A selling, general, and administrative expenses were noisy this quarter.
Ah, yes, noisy.
Now, when an executive calls a line item noisy, that is almost always code for, we spent a lot more money than we wanted to, and we need you to ignore it. Let's translate this noise. What exactly were they spending millions of dollars on?
The transcript breaks down the noise into 3 specific buckets. First, they incurred $4 million in executive management transition costs.
Let me stop you there. Transition costs usually means they fired someone very senior, very expensively.
Precisely. It typically covers severance packages, accelerated stock vesting, and recruiting fees for replacing high-level executives. It is a sunk cost of restructuring leadership.
Okay, bucket 1 is executive shakeups. What's the second?
Second, they noted a $2 million one-time expense true-up from a prior period.
A true-up?
Yeah, a true-up is essentially an accounting correction. It means they underestimated an expense in a previous quarter, the actual bill came due, and they had to record the difference in this quarter to make the balance sheet accurate.
All right. And the third bucket?
Finally, and most significantly for the long term, they cited generally higher labor costs across the board. This is a macroeconomic reality. Keeping ushers, security, and union stagehands employed is simply more expensive in an inflationary environment.
But they aren't just accepting those higher baseline costs, right? The transcript mentioned a specific, actionable plan to get the SG&A under control.
Right. Management announced a voluntary exit program designed to streamline the organization. They're offering buyouts to reduce their corporate headcount.
Trimming the fat.
Yeah. They warned investors that executing this program will result in an $8 million severance hit in the upcoming March quarter. However, they project that by the June quarter, their overall SG&A run rate will normalize at a much lower, more efficient level.
It's the classic corporate playbook. Take the pain today to expand the margins tomorrow. They are taking an $8 million charge now so that the core business is lighter and more profitable heading into their next fiscal year.
Exactly. It's a short-term hit for long-term gain.
Now, beyond the income statement, there were 2 major strategic long-term threads mentioned in the call: real estate and partnerships. Let's talk about the real estate first, because MSG sits on arguably the most complicated and vital piece of infrastructure in North America, which is Penn Station.
Yeah, an analyst specifically asked for an update on the Penn Station redevelopment, and it is a critical variable for this company's future.
Right.
The Department of Transportation and Amtrak are currently steering a massive, multi-billion-dollar initiative to redesign and rebuild Penn Station, which physically sits directly underneath Madison Square Garden.
And MSG's operating permit, their air rights, their entire physical existence is intertwined with the politics and the architecture of that train station beneath them.
Exactly. Management noted they are actively collaborating with the transit agencies and expect a master developer to be chosen by May 2026.
Okay, so a ways out.
While this doesn't impact next quarter's earnings, it is a massive looming catalyst. Any structural changes to Penn Station will directly affect the ingress and egress of the millions of people trying to enter the garden. It is a long-term infrastructure story that investors absolutely must monitor.
That makes total sense. What about the partnerships?
On a more immediate front, they highlighted their partnership strength. They announced a multi-year renewal with Anheuser-Busch and secured a new naming rights deal with Infosys for the MSG Theater.
Which is a strong leading indicator of corporate confidence. I mean, if massive global brands are willing to sign multi-year, multi-million-dollar contracts to attach their logos to the building, it validates the enduring cultural relevance of the venue. Brands don't buy naming rights to empty buildings.
Exactly. The corporate sponsorship market is highly analytical. If those brands are renewing, it means the audience demographics and engagement metrics at MSG are delivering an undeniable return on investment.
Wow. Okay, we have covered a massive amount of ground here. We've translated the raw financial data. We've explored the operational reality of 1.2 million holiday tickets. We've analyzed the behavioral economics of concert merchandising, and we've unpacked their future playbook of residencies and corporate restructuring.
We hit all the pillars.
This brings us to the most important part of the deep dive: We need to synthesize all of this information for the listener who is trying to decide what to do with this stock. What is your bottom line read on MSGE right now?
Based on the totality of this earnings call and the underlying data, my stance is highly bullish.
Bullish, okay.
The thesis boils down to two critical factors: immense pricing power and strategic risk mitigation. We discussed the margin pressures, the inflationary labor costs, and the impending $8 million severance charge.
Right, the noise.
Those are real headwinds, but they are internal, solvable inefficiencies. The external reality, the consumer demand for the live experiences MSGE provides, is incredibly robust.
Because they can pass the costs on.
Yes. The fact that they could push the Christmas Spectacular to record ticket yields, absorb a drop in international tourism, and still price the event competitively within the New York market demonstrates massive, untapped pricing elasticity. They have a product that the consumers view as essential, which gives them the leverage to continually raise prices without destroying demand.
And on the risk mitigation side, they are attacking the fundamental weakness of their industry.
Yes, exactly. Live entertainment is historically punished by investors because cash flows are erratic. But by securing massive guaranteed rental residencies in their historically weakest months, they are effectively smoothing out their revenue curve.
The Harry Styles effect.
They have de-risked the first half of their fiscal 2027 before the year is even started. Combine that operational visibility with a management team that is aggressively paying down debt and retiring shares, and you have a company that is engineered to generate cash and efficiently return it to the shareholder.
So let's give the listener some concrete homework. If you hold this stock, or if you are considering building a position, how do you track this thesis moving forward?
Next time you look at MSGE's quarterly report, do not get bogged down in the raw ticket sales numbers. Look specifically at their venue utilization rates, particularly in the summer months.
Okay, the summer dead zone, right?
Are they continuing to book multi-night residencies that fill the August and September dead zones? If the building is empty during those months, the stock remains vulnerable to the old hit-driven cycle. But if they continue to execute this residency strategy and keep that building lit up 200 nights a year, they are fundamentally altering the valuation multiple of the company. Watch the utilization rate. That is where the long-term value will be created.
That is a highly actionable takeaway. Don't look at the art, look at the calendar efficiency. But before we wrap this up, I want to leave you, the listener, with a new thread to pull on. It is something management only briefly touched on at the very end of the call, but it points to the next evolution of this industry.
Oh, the audio tech.
Yes. They mentioned that they recently debuted a new proprietary technology called Sphere Immersive Sound at Radio City Music Hall.
It's a fascinating initiative. They are taking a historic 90-year-old Art Deco theater and retrofitting it with next-generation directional audio technology that was originally developed for their massive Sphere project in Las Vegas.
It is the collision of legacy architecture and futuristic engineering. And here's a provocative thought I want you to mull over. What happens to the broader live entertainment ecosystem when legacy giants like MSG initiate a technological arms race?
That's a great question.
If MSG can take a historic venue, invest millions in proprietary immersive sound, and guarantee that an artist will sound fundamentally better in their building than anywhere else on Earth, what happens to the mid-tier independent venues? Will this capital-intensive audiovisual arms race widen the economic moat for the giants, making it practically impossible for smaller venues to compete for top-tier touring acts? Because ultimately, if you are a musician, your ego demands that you play the room that makes you sound the best.
And if you are a consumer paying a dynamically priced premium for a ticket, your expectations rise. You no longer just want to see the artist, you expect a flawless, immersive sensory environment. The physical capabilities of the venue become just as critical to the experience as the performer on stage.
The magic trick doesn't just get more expensive, it gets a massive technological upgrade. And suddenly, that cold, optimized financial machine we talked about at the beginning of the show becomes even more complex.
Way more complex.
Because now, the machine isn't just analyzing your demographic to sell you a t-shirt instead of a beer. It is actively engineering the exact physical sound waves hitting your eardrums to ensure you have a transcendent emotional experience, guaranteeing that you will come back and feed the machine again next year.
Exactly.
Thank you for joining us on this deep dive into the Madison Square Garden Entertainment earnings call. Keep reading the transcripts, look for the mechanics beneath the magic, and always question the numbers.